Money FM 89.3, best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning, folks. Welcome to the U.S. Markets Wrap with me, Ryan Huang. We've got a bit of a lackluster session last night on Wall Street, a bit mixed. We are seeing the Dow Jones Industrial Average down 0.5% to 43,969. The broad S&P 500 slightly underwater, 0.1%. And on the flip side, the Nasdaq Composite squeezing out a gain of 0.4%. And that comes as we see some profit-taking overall coming through after what has been quite a solid week for markets. Let's check in now with David Abella. He is the Director of Investments at GoalVest. David, thanks for joining us on the show. How are you doing?
Great, thank you.
All right, great to have you on. Let's start first with what you are taking away from some of the market action right now. How much momentum is there going, seeing how perhaps there's already some sign of profit-taking?
Well, there is profit-taking going on, but we're still up a bit for the month. And, of course, year-to-date, the numbers are very attractive. So if we can continue at that rate, 2025 will be a very strong year in U.S. markets. But I would say that we're currently, it feels like, and it's an old-timers expression, but climbing a wall of worry because everyone, investors, you hear a lot, the S&P's at a rich valuation. No one likes the tariffs. There's still a lot of tariff uncertainty, worries about stagflation. Yet the market continues to generally plow on and really driven by earnings.
Yeah, so I'm looking at some reports which describe August as a stock market's worst month. And to your point, there is this wall of worry. How much are you worrying?
Well, I think to go back to earnings, so through the first two quarters, and especially the second quarter, earnings on average were up 10.3%, and the initial expectations were for 5%. So earnings are still pretty strong, but the tariffs do worry me, and I am worried about stagflation. I think if we start to get in a stagflationary environment where the growth in the U.S. does slow and then the prices are just going up, not too high, but just back in the 4, 5, even 6% range, that won't be so great for the market, but we're not there yet. Right now, it's still a worry, and, it hasn't happened, so we have some optimism.
All right. What are you seeing from the commentary and the tone of the earnings right now? We've been talking about tariffs. We've been talking about a potential global slowdown. Has that manifested or have been priced or reflected in some of the comments from the CEOs talking about what's coming up?
Yeah, it's very interesting. So while the aggregate earnings in the second quarter so far, it's about 70% of the companies, while they're up 10%, there has been some real misses, some companies warning on tariffs. The U.S. auto companies, which are ironically supposed to be helped by tariffs, it's really affected them a lot, and they wrote down billions of dollars. The stocks kind of had it priced in, so there wasn't too much movement. But the real losers are retailers, especially apparel retailers, some of the more consumer-driven. One area that we're finding opportunity is tech, and tech is kind of the muscle behind that earnings growth. And the tech stocks, on average, the aggregate tech index is leading the U.S. market still.
Okay, so are we looking at Mag 7 or rotating to other plays here?
Well, it's really beyond Mag 7. There are some other winners, a name like Palantir, which, that's kind of almost too hot of a stock, but it's data analysis with AI, and that stock is kind of leading an index such as like an ETF, which is the SPDR, New York Stock Exchange Technology ETF. That's a great way to play tech diversified. It has some Mag 7, but it has other names as well, like Uber and Palantir, as I mentioned. It has AMD, Lam Research. So it's some of the Netflix, some of the usual suspects, but beyond just the 7 top names.
Yeah, to drive home your point, Palantir has seen its share price up over 500% in the past year. So definitely a lot of action going on in tech. Beyond tech, are you looking as well at dividend-paying companies to kind of diversify your portfolio?
Yes, absolutely. So we have these worries of some stagflation and maybe some choppiness in U.S. markets. So dividend stocks can tend to be a defensive way to still have equity participation, but avoid some of the volatility. And in particular, if interest rates start to come down, and there is pressure out there for the Fed to start reducing rates, dividend stocks are generally, that's a good tailwind for them. It's a good environment for dividend stocks. So we would look to get something, they say, in the 4 to 5% yielding range, something that can grow the dividend and then hopefully help if interest rates do come down. And also something that would be a little bit immune from tariffs, the nature of their job. It's tough in the U.S. to be totally immune. It's so in the supply chain that everyone's affected in a way, but you pick and choose a name that's more insulated.
Yeah. Do any names come to mind when you talk about dividend-paying companies? Where do you find these typically, in which sectors?
Well, it is a mix, and there are some big-name consumer staple companies. We own, McDonald's and Procter & Gamble, for instance. McDonald's has been a good name year-to-date. Procter & Gamble hasn't, and I think Procter & Gamble's seeing consumers a little stretched, and they're not spending maybe as much on the premium products. But, we have confidence in Procter & Gamble and their mix, so that would be a name. And there's some energy opportunities, too.
Okay.
Some pipeline companies in the U.S. So it's a wide mix.
Yeah, David, how should investors be thinking about the U.S. dollar, which in the past year has been softening? I'm looking at the dollar index. We are seeing it down nearly 10%. So what does it do for earnings, and is it going to weaken further? Yes,
it does seem like it would weaken further. And if the U.S. starts to cut rates, say, prematurely, if you will, before there is that real beating of inflation, I think that the dollar could be at further risk. That may help a company like McDonald's or Procter & Gamble that has international operations, because that offshore money becomes more valuable. But it's tough. It'll be tough on the stagflation numbers and tough on the economy if the dollar continues to weaken. But it does make overseas developed markets investments more interesting, and that's an area that we've looked at as well.
Okay, so you've got a weakening dollar, you've got potential rate cuts. Is this still the time to get into gold?
Yeah, so gold is an asset we've liked, and particularly recently, and it has to do with the weakening dollar and stagflation and the idea that the Fed may cut rates too soon. And it's a way to kind of preserve capital. Dividend stocks can be defensive, but if the markets get too choppy, there's still equity names, and they can go down. And so gold, we think, is a good hedge for that. And really, if you look at where gold could be and relative to reserve buying by all the countries and adding more gold as their reserves, I mean, there's estimates that, in the 4,000, even higher range. So we think it's a good hedge.
Yeah, just to give you an idea about where gold is right now, year to date up some 29%. In comparison, the S&P 500 up some 8%. So again, outperforming equities for now this year. And helping us out this morning to talk about markets has been David Abella. He's the Director of Investments at GoalVest. David, it's been great chatting with you. Thank you so much for your time and insights.
Yeah, thank you very much. Great to talk to you.
All right, we'll have you back on again soon. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.